Welcome back to EDS, and in this video I'm going to show you how to conquer the market this year step by step. So the first thing that you want to do is open up your brokerage platform, and we are not going to be taking any directional trades. We're going to be placing delta neutral trades, which means that we don't really care if the market goes up, down, sideways, left or right. We want price to stay within a specific range, and this is going to give us, or this is one of the reasons why we are going to have an edge over the market moving forwards. So once you have your brokerage platform open, you want to navigate over to where you can see a list of futures underlyings that have options contracts available to trade on them. If your broker doesn't display this as a default watch list, then just copy down these ticker symbols and make your own custom watch list. We are going to be writing options contracts on futures. This is because writing options allows us to control our probability of success before we enter the trade, and futures uses span margin, which allows us to be very capital efficient, and that's going to give us very high returns on our capital. So once you've got everything set up like this, you want to make sure you have the IV rank metric on your watch list, and then you want to order your watch list from high to low IV rank. And this is because we want to sell when volatility is high. This is because volatility has an effect on options prices. When volatility is high, option prices are high, and writing contracts means that you are effectively short those contracts, and whenever you're short, you want to sell high, buy low. So when volatility is high, we want to short, and this is basically, we're going to be using options as a proxy to short volatility. And volatility is contracting in the market about 80% of the time. That's one of the other reasons why this works so well. So we don't want to look at anything with an IV rank of under 30. So in this instance, our cutoff point would be here at the 30-year bonds. This has an IV rank of 30.8. Anything with a rank of over 30 is considered to be high. Anything over 50 is considered to be very high. And I personally like to be in and around the mid to high range. Now, if you have a smaller account, you probably want to stick to things like currencies, bonds, soybeans, things like that, as they don't require much buying power to open the trade. However, if you do have a larger account, then feel free to choose anything you like. Whatever you do choose, make sure that it complements your portfolio well. Keep everything nice and diverse. You don't want to be too heavy in any one sector or industry. With futures, you have a wide range of things that you can trade, so it should never really be a problem. So what we're going to do is we're just going to have a look at live cattle, because we've not had a look at that in recent times. It has an IV rank of 40.6 and an absolute level of 17.6%. So let's open up the trade tab, which is where we can see the option expiration dates. Now what you'll notice is we have the expiration dates here on the left, and then next to it we have the corresponding futures contracts that line up with those dates. So for example, March 7th, April 4th is the LE J5 futures contract, June 6th is the M5, August 1st is Q5, so on and so forth. You don't really need to worry too much about which futures contract it is that you're going to be writing contracts on, because your broker should pretty much line everything up like this for you automatically. We want to focus on the option expiration dates, and the one that we want to pick needs to be between 30 and 60 days out in time. So as we can see here in the middle column, there's one available that has 53 days left on it, April 4th. So we're going to open that up, and now we can see the options chain. And here, very quickly, I'm going to explain what's going on. We've got calls on the left, puts on the right. We can see where the price currently is with this horizontal orange bar, and we can see where price is with respect to the strikes that go down the middle. In the top right corner, we have our IV at 17.6%, and next to that in parentheses, we have our expected move, which is currently plus or minus 8.3. And that is also visually displayed with this vertical orange bar, and we have our standard deviation levels shown by these dotted blue lines here. So the first set of dotted blue lines are our one standard deviation level, and then so on and so forth. We've got two standard deviations, and on the call side we have our positive deltas, on the put side we have our negative deltas. So that's what's going on here. So without further ado, let me show you the exact strategy that you want to implement. Now what we want to do is sell one call and one put. Very, very simple. Now the question is, where do we sell them? So whenever you are short an options contract, you basically want price to stay away from that contract. You don't want price to go near it or breach that contract or that strike, sorry. So what we're going to do is we're going to use the expected move. So if you know what the expected move is of the underlying, then we simply just need to sell contracts outside of that expected move to get a high probability of success. Now, the further out you go, the higher your probability of success will be. However, the less premium you will also collect, and the less premium you collect, the lower your return on capital. So a nice balance, in my opinion, is to be around the 1 standard deviation level, which will typically line up with a 15 to 20 delta. So on the call side, we have a 15 delta here at the 210 strike, and on the put side we have a 16 delta at the 186 strike. So what you'll notice is that both of these contracts are close to the 1 standard deviation level. We are outside of the expected move, and we're around 15 to 20 deltas, and all three things should line up pretty much almost every time on every underlying. Now, so what's happening here? Well, what we've done is we've created a range for ourselves between 186 and 210, and we want price to be within this range at the point of expiration, which is going to be in 53 days time. And the probability of that happening can be seen in the bottom left corner with this pop number here. Pop is your probability of profit. So this is your probability of making at least 1 penny on this trade. So to be exact, we have this green bar here as well that's now displayed, and that's our break-even bar. So this is basically showing us if price is anywhere within this green bar at the point of expiration, we will at least break even or better. And the reason why the green bar extends past our contracts is because we collect a premium up front, and we keep that no matter what happens. And right now it's currently at 2.000. So it would be 2 plus 210 to get our break even, and it would be 186 minus 2 to get our break even on the put side. That's why our break even points extend past our contracts. So basically we have a 71% chance of making at least 1 penny on this trade. So already we have an extremely high probability of success. Now that's if we hold all the way till expiration, but what if we don't want to hold till expiration? What if we want to get out earlier, say 50% of max profit? Well, we have this P50 number here, which is not displayed for futures, it is for equities, but your P50 is typically going to be about 10 to 15% higher than your pop. So you'd be looking at a P50 of between 80 and 85%. So just to recap, we have a probability of success of between 71 and 85%, depending on how long you want to hold this trade. If you want to only hold till 25% of max profit, you're probably going to get a probability of success of over 90%. So we are looking at very, very high probabilities of success here. Now, how much money can we make on this? So this is the price that we would look to get filled at, 1.975 right now. And you would multiply this out by the contract multiplier. For futures, it varies per underlying quite a lot, but you don't need to worry about the multiplier here because your broker will do it for you. And once everything has been multiplied out, we would collect in dollar terms $790 in premium upfront as soon as this order gets filled. And our broker is only going to require $1,000 or just over $1,000 to open this position. So we're going to collect $790 and our broker is going to use the $1,000. So as you can see, we've basically got an 80% return with an over 80% chance of success if we want to hold till say 50% of max profit. So this is an extremely powerful strategy. We are getting high probabilities of success and high returns on capital, and this is all based on statistical analysis. This is not based on a guess or a theory or a trend line or anything like that. No disrespect to anybody who trades like that, but this is based on statistical analysis. Okay, now if you want to get an even higher return, let's say you go to the 20 delta, okay, on either side. Now we're at the 20 delta on either side. We're still outside of the expected range. Now we're going to collect $1,080, so just under 1.1k in premium, and our broker is going to use just under 1.2k. So we're pretty much at 100% return here. And remember, this is in 53 days time, not over the year, in 53 days. So you can turn this money over multiple times over the year. Now, you do need to keep in mind how much buying power you are using on on your positions. And in order to figure out how much you should be using, we've created a free position sizing template that's available for everyone to use. The link is in the description. Just click the button. It will take you over to the spreadsheet, and the way it works is you enter in the size of your portfolio at the top. So say if it's $10,000, and then below you can enter in whatever the current VIX level is. So say if it's 32.1, and then everything will then be automatically calculated for you. It will tell you exactly how to structure your portfolio, the minimum and maximum amount that you should be allocating to your positions based on what type of position it is. For example, the one that we went over today is an example of an undefined risk position. So in the case of this example portfolio, you would want to allocate a maximum of $700 per position. Let's say if you had a $25,000 account, then you'd want to allocate a maximum of 1.75k to an undefined risk position. And as long as you follow this, over the long run, you will be absolutely fine. If you do want to learn in more detail about what we do and how we do it, again, link will be in the description. This time, click on EDS Premium. Get yourself signed up. Inside, you'll have access to our portfolio that allows you to see the positions that we're placing, how we manage risk, how we make adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It is a private community, so if you ever get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee as well. So once you've studied the full course, followed some of our trades, if after 6 months you are not profitable, then we will work with you for free until you are, or you can simply just request a full refund. So it's completely risk-free. It's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life. And that's not a sales tactic. The price was £1 a month before, that was less than a month ago. Now we've increased the price to $9.99 because the first wave of members have joined. Once the second wave of members have joined and is full, then we will be increasing the price again. So you are rewarded for getting in early. Whatever price you get in at, that's the price that's locked in for you, no matter how high the price goes thereafter. And the aim of EDS Premium is to teach you the skill. We do not want to keep you dependent on us. Once you have learned the skill, it's something that you can take with you for the rest of your life. No one can ever take it away from you, and we want to get you to that point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.